Today we're going to talk about purchasing business with property. So this one is even more tricky than other deals because this one you're buying the business and the property, right? So you're doing two deals in one contract. So the task first is to buy a business, and second is to buy the property. So this one, because you own the property, there's no lease involved. You own the property. Okay. The parties are involved are sellers, buyers, accountant, lawyer, mortgage agent, inspector, listing agent, selling agent. There may be other parties involved. For example, like surveyor, they measure the land, right? And how about the environmental company? They come do the environmental report, right? There are other companies involved. So a lot of people are involved in a transaction like this. So first, you have to do an asset sale, okay? So are you buying the business goodwill? Because for example, if your client wants to buy a hotel normally are owned by the owner, both land and business. Hotels are probably 90% owned by the same owner, both land and business owned by the same owner. They don't pay lease. I've seen some hotels are leased from different owner and they run a hotel. But most times hotels are business with property. Leasehold improvement. So leasehold improvement is what they call the renovation. Leasehold improvement is all the renovation they put into the property. That's called leasehold improvement. And then lease agreement. So most times they own the property, there's no lease agreement. But sometimes there are lease agreement if you don't own the property. And there will be lease agreement if you have the property partially leased to another tenant. For example, if you're having a big plaza and you run a business inside the plaza, you're the anchor grocery store, right? And you have so many other retail stores you lease to other parties. So there will be lease agreement involved. You have to look at all the lease agreement as well. And if you're running a hotel, there may be one liquor store that you don't run, you lease to someone else to run the liquor store, right? So that's when the lease agreement comes out. And you're buying the equipment, vehicles, and all the employees working there. You don't want to buy a property with business and nobody working there, right? Then your business will be collapsed. So it's including everything to run the business. And there are some must-dos. So when you're buying a business with property, you have to do a liability search. See if the company owes any money or has any equipment that's mortgaged to a third party, or any equipment are leased. They don't own the equipment, it's leased, right? You have to find out everything by using a lawyer. Accountant, they have to give you a financial statement and you provide it to your accountant to look at it. See if there's something funny about the financial statement that you don't see, but your accountant can find out if there's something wrong with the financial statement. And lastly, inspector. Because you're buying a property, then you have to find a commercial inspector to look at the building. Anything wrong with the building, anything need to be repaired or fixed or replaced with the building. So you have to get a commercial inspector to your deal. And also there's a different type of sale. It's called share sale. So before, the last one we talked about is the asset sale. You're not taking over the company. Because when you're taking over the company, you also take over the liabilities. If the company owes money to third party, then you have to pay the debt, right? But this way, for share sale, you assume everything, even the debt owing to other companies. So the reason why you want to do this is a lot of times when you do asset sale for property, there is a property transfer tax tax on the property. But if you do a share purchase sale, there is no property transfer tax for the property. So if the property worth $10 million, right? You save a lot of money on property transfer tax. That's why a lot of people choose a share sale. And for sellers, once in a lifetime, they have a grant tax benefit for selling share. So the seller wants to sell shares to earn more money, right? They pay less tax. So there's a tax benefit to the seller. So that's why a lot of times you're doing a purchase sale instead of asset sale when you're buying a business with property. You're buying the whole company. So another thing about buying a company is that if the company has lost for the past 10 years, keep losing money, right? That means when you took over, you're starting to earn money. The loss will become your deduction from your earnings. So you don't have to pay tax until your loss are balanced from your earnings. So there's another tax benefit of buying a property. So there are some people, they like to buy companies with a lot of loss. So when they take over the company, they're starting to earn money, they don't have to pay tax until the loss are all gone, right? Accumulated loss are all balanced out. So you have to, same thing, find a lawyer to do liability search, accountant and inspection. You have to do everything the same to find out if the company owes any money. Then you can negotiate with the seller saying, hey, you still owe this party $1 million. So you have to credit back me the $1 million on the sale price so I can pay it off, right? So you have to do that search. That search is normally from anywhere 4 to 6 weeks. So when you're writing contract subject to removal, this must be anywhere from 4 to 6 weeks. If the lawyer tells you, hey, we need 8 weeks, then you have to extend it to 8 weeks, right? This is very important. The difference for purchase without shares, you have to pay property transfer tax and no company liability, which is a good thing. But if you're buying shares, there's no property transfer tax and there's first-time tax grant benefit for the seller. But you have to assume all liability from the company. So there are good and bad for purchase asset or just purchasing the sale. Required document. So if you do this, most times are companies, right? You have to get registered certificate for the company. Notice of articles, it shows all the directors. And then photo IDs for the signing officer. Financial statement and balance sheet. Employee payroll. For the employee payroll, it shows how many employees they have and how much they pay each employee. Equipment list, asset list, what does it include in the sale? All the lists and how much they're worth on the market. Invoice of equipment. If they have this equipment, they better have the invoice for them because to prove that they own it, right? They're not leased. So if they're leased, then you have to continue to pay the lease. So they don't worth anything. You don't pay them because it's leased. They don't own, right? And environmental phase 1 report. And of course, there are other documents you may need to require. For example, annual report. See if the company is still in good standing, right? So there's more to that. Contract. So you can use purchase sale agreement for business asset. You can use this agreement. All this agreement you can find out from the web form. Okay. Property. Purchase and sale agreement for commercial real estate. When you buy property, you can use that. And for share purchase, there is a share purchase addendum. You can also find out from the web form. Okay, so when you're doing property with business, then you have to combine all this into one agreement. So the one you can use is business asset. So I find that one may be the easiest to use and you use the share purchase addendum for the addendum part. So when you say all the business, and then in the addendum you would say this is a purchase sale, the purchase price is including all the shares, 100% shares of the company, right? And then some details that you have in the addendum. But you can vice versa, using the purchase sale agreement for commercial real estate, same thing. Clauses. So you can put these 3 clauses for purchase a share if you want to. This purchase price is including 100% share and all assets of this company. This purchase price is including the business, the name of the business. This purchase price is including the property located at this location, PID number and legal description. So this is the addendum you find out from the web form. So number 1, it says the seller warrant and covenant with the buyer as following. The company is or will be at the date of closing in good standing in British Columbia. So like I said, if they have an annual report, they can show you that is in good standing. The seller is the owner of the shares as described, which are fully paid and non-accessible and clear of any liens, pledge, escrow, or other forms of mortgage. So when they sell to you, they cannot owe money to other parties. They have to pay everything off. The seller has right to enter into this agreement for real estate of the share, and no other person has right to purchase the shares or any of the unissued shares in the capital of the company. So this seller has the right to enter agreement for selling the shares. Okay. Sometimes they may not have the right, so they have to have a vote of all directors, or they have to have a document prove to you that the vote has already been done and everybody signed off on it. The directors and officers of the company as follows. So you list everybody on this agreement. So those are the people who are the directors in the company. The company has good and marketable title to the asset listed in Schedule 1 and has the corporate power to own this asset and to carry on the business carried on by it. So the company actually owns the building, actually owns the branding, right? So they have the right to operate this business. And the date of closing, there shall be no liability, contingent or otherwise of the company except as set out in Schedule 2, other than accounts incurred in the ordinary course of business and accurate but unrealized capital gain upon in an increase in the value of the asset of the company. So this would be at the closing date. When they sell the stuff, there will be a capital gain involved because the property was bought maybe 10 years ago. Now when they sell it, right, the value may be increased. So there will be a capital gain. For example, they bought for $1 million. Now they sell for $10 million for the whole thing. So there will be a capital gain involved. And then the business of the company will continue to be carried on in the ordinary course until closing. So they have to keep running the business as normal. There are no actions, investigations, or proceedings outstanding or pending or to the knowledge of the company or the seller threatened against the company. So the company is in good order. Nobody's suing it. Nobody's doing litigation. Okay. So to the seller's knowledge, the company is not in breach of any law which apply to it, and the company has the necessary permit and license to carry on the business. So everything is doing according to law. So they have done nothing to violate the law. All tax return and reports of the company which are required by law to be filed by it prior to the date of closing have or will be filed and are or will be substantially true, complete, and correct to the best of the seller's knowledge. So before closing, they have to use an accountant to calculate everything up to date, right? If the company is losing, is owing any tax, is the most updated report, and they have to do that before the closing. All financial transactions of the business and the company have been fully disclosed to the buyer, and the financial record of the business and the company inspected by the buyer are accurate and complete. They fairly and accurately represent the business and the company's financial operation of the period covered by the statement. So everything they disclose to the buyer must be true, right? So they have to disclose everything to the buyer, all the financial related. All material transactions of the company, all directors and shareholders, resolutions, and all other corporate proceedings have been recorded and filled in the books and records of the company. So they have the record of the company when they do meetings. So when they agree on something, it's all recorded in the books. So when they agree to sell the business, to sell the building, it's all recorded in the book. So all the meeting record they have to provide, because they are assuming the company, they have to know what is going on with the company. So without the record, they don't know what happened to the past, right? The agreement of the sale of the shares does not give any person a right to terminate or cancel any agreement or right enjoyed by the company, and will not result in the creation of a lien, encumbrance, or a restriction in favor of a third party upon the asset of the company. And the representation of the seller contained in this paragraph shall be true and correct both at the date of this agreement and the date of closing. So nobody after the accept offer should or can do, like for example, after there's an accept offer, I mortgage the building for more money, or I borrow more money and put my equipment on a lien, right? So nobody can do that or should do that. Good, okay. So restrictive covenant, it says after the sale, how many months the sellers who are involved cannot do the same business in a certain area. For example, if I sell you this automotive store and I cannot open one, for example, if you are in Richmond, I cannot open one in Richmond for 5 years. So it's like a non-competition clause saying that I cannot go back and compete with you to steal your client. And number 3, buyer's covenant. The buyer covenant to complete the share purchase subject only to the representation and warranty of the seller being true and correct as of the date of closing. So the buyer will close the deal if everything's true disclosed by the seller. Closing procedure. On the date of closing, the seller shall have arranged to deliver to the person representing the seller the certificate of the share of the company endorsed in blank, resignation of the seller as officer and director of the company, and such other document as may have been arranged upon by the parties. The buyer shall deliver to the person representing the buyer a draft or certified check for the balance of the purchase price, subject to adjustment, payable on the closing date. So the buyer provides a bank draft to the seller, then seller provides a share certificate to the buyer. So they're handing over their powers. So resignation from the seller, they step down as director, the owner, shareholder, and the buyer becomes the shareholder, the directors, and then they give them the money. So general, this addendum shall form part of this commercial purchase and sale agreement, but where there is any conflict between the provision of this addendum and the remaining part of the commercial contract of purchase sale, this addendum shall prevail. It means if they have agreement, right, in a commercial purchase agreement, they have same content with addendum. Addendum always prevail. So anything in the addendum will overwrite whatever content in the commercial purchase agreement. Same thing as residential, right? So if you have an addendum will be the source you look out for. For example, you say in the purchase price, we agree to sell for $1 million. But in the addendum saying, everybody agree that we change the sale price to $900,000. So in the end, you will follow the addendum using $900,000 as the purchase price, right? So when you buy in business and property, so you have to do a lot of work to make sure your client, your buyer are protected. Because normally with this kind of business, it's very big. It's either 5 million, 10 million, could be 20 million, right? So liability is huge. So you want to make sure you have a commercial lawyer, you have a commercial inspector, an accountant who knows company, corporate accountant, or CPA, CGA, right? So you have to find out professional people to partner with you on those cases. So otherwise, if you do any advice to your client, liability is on you. But you're a realtor, you're not an accountant, you're not a lawyer. So you have to find those professional people to give your client advice. Okay, don't tell your client what do you think, because you can only tell your client about real estate, nothing outside of real estate. No tax advice, no law advice, right? Those are lawyer, accountant. If you like this video, please share and subscribe. Leave your comments below. See you next time.